How are we doing, guys? Welcome to today's session. I am going to give everybody a few moments to join, and then we're going to jump straight into the topic of the day, which is understanding your Darwin, or more of a complex breakdown of what a Darwin actually is and why every trader should have one. So we'll give everybody a moment to join, and then we'll get stuck in. As always, as I go through the session, I appreciate that not everybody is going to understand some of the lingo that I talk about, or I might not explain something to, so that you can understand it exactly. So please stop me at any point. Just write a comment, whether you're watching on X or YouTube. Just put it in the chat box, and I will take a break and explain to you. How are we doing, JC? Pleasure to have you here again. 1 a.m. For you, at least, not for me. It's early afternoon. Well, late afternoon for me. But yeah, 1 a.m. I mean, sitting watching streams at 1 a.m. You are just a machine, man. Also, I'm thinking. I know I mentioned it either yesterday or a couple of days ago, but I'm thinking of potentially scrapping these sessions in terms of having set times where we come on and have these sessions. Probably keep that routine to a degree, but having more of a Darwinex TV stream where we jump on, we look at charts, we look at markets, we discuss Darwinex, a bit more of a free flowing stream. Maybe we do it for an hour and a half, 2 hours or something, a few times a week. And then we cover one of these sessions during the stream so that it's not a, kind of a 30-minute stream where we just do a presentation. I appreciate sometimes that's, not the most interesting of topics. So if you think that'd be good, let me know, because I'd like to kind of see whether you guys would be up for that before I start coming on and doing 2-hour streams where we just talk markets. And what I mean by talking markets is we can get charts up, we can discuss, your Darwinex Zero accounts. I can bring traders on, we can have chats, we can have roundtables, just completely kind of like free balling it. PX Lou, how we doing? Hope you're all good. I'm all good, JC. I'm actually feeling a lot better today. Still got my water bottle full of water, but I actually feel a lot better today. My throat's not feeling like it's got a ball stuck inside it. Doesn't really sound the best. Anyway, with that, we'll move on. So welcome, guys, to today's session, which is all about understanding your Darwin, where we talk about your Darwin in more detail from a risk perspective. So we talk about what is a Darwin, we talk about what is value at risk and how it affects your trading. PX Lou has jumped in with a question straight away, which I absolutely love. Perfect question for our NQ volatility today. When it's volatile like that, big ass candles, does a risk engine scale you down automatically? Yes. Okay. So in theory, yes, it will. Because if the asset is higher in volatility, then yes, the risk engine will take that into account as part of the calculation for your value at risk, which we will get onto in this session. So don't worry, we'll go over that. However, it's not going to be to a degree that it will you'll even notice. Okay, because there's so many factors that affect your value at risk. And your VAR is kind of an average of your trading history over the past 45 days and past 6 months, again, which I'll explain in a little bit more detail shortly. So yes, it does, but no, it's not going to affect you to the point where you even notice it. I would presume. So anyway, my name is Kieran. I'm head of UK growth and business development here at Darwinex and Darwinex Zero. And if you're unfamiliar as to who we are a regulated broker, asset manager, and hedge fund. We are regulated by the FCA in the UK, by the CNMV in Spain, and by the FSA in the Seychelles. And we're currently in the process of getting our CISEC license in Cyprus as well. We're kind of in the final stages of that, so I presume it would be this year. But I don't deal with all the regulatory stuff. That's way too complex for me. Sajadrain, is it possible to make 90% on your Darwin, but VAR shows only 3%? Not sure what you mean by that. I'm not sure what you mean by that. Explain that a little bit more, and I'll try and answer it as best as I can for you. We have over $100 million US invested on our platform. which is held under our asset management license and invested into traders on our platform. We also have our own proprietary capital in our proprietary fund and our hedge fund. And we have over 10,000 active strategies on the platform. That includes traders from Darwinex, Darwinex Zero, traders in calibration phase, in silver, in gold, all of the above. Our main job as a business is to find the best trading talent in the world and to raise capital from investors and from ourselves as a company to allocate to these traders who wouldn't have the opportunity to scale real investor capital outside of Darwinex. Okay, JC asked a quick question, which I'll explain before we start on this slide. Just a question about the ROI shown on a profile versus the rate that Darwin grows at. For example, THA has a total percentage return ROI that is different to the actual Darwin being up all the way at 900 after starting 100. Okay, so your Darwin quote is compounded, but of course, if you're looking at singular month or year returns or percentage returns, it's not going to align because the return or the total Darwin quote is compounded. Gabs has asked, we'll get another account after passing the calibration phase because I see people usually have 100K, but I got 1 mil. No, you won't get another account. You will, the account you get provided at the beginning of your journey with Darwinex is the account that you will trade forever. You can have 100K or 1 million depending on what asset type you decide to trade. So futures, for example, or stock and ETFs account, you would have $1 million in equity, whereas CFDs, you would have 100K. But there's no difference. You won't receive another account. That one account will be your account forever. Now, kind of a fundamental question. Again, I was supposed to add a slide last week because the past couple of times I've ran this session, I've kind of realized that actually we're missing a fundamental question here, which is what is a Darwin? Okay. So before we look at what the point of a Darwin is, we kind of have to understand actually what that is as a product. And a Darwin is essentially an indexed version of your trading strategy. So what it does is it takes all of the trades that you place as a trader, combines it with our risk management from our proprietary risk engine, and builds an index. That index is held under our asset management license, meaning that you can legally onboard investor capital without having to go out and get qualified, regulated, or licensed in your own right. Now, because of that, you don't actually physically ever touch the money because, again, that's illegal to do in most jurisdictions, but especially here in the UK. If you're managing capital for somebody, you have to be, licensed as a financial advisor, or it comes under account management instead of copy trading, which is just an absolute no-go. So that is what a Darwin is, an indexed version of your trading strategy. Now, I also think an important point to bring up here is what is the risk engine, right? Because I mentioned the risk engine and I said that the Darwin is an index of your trades and the risk engine or our risk management. So the risk engine is a proprietary piece of software that we built at Darwinex, which monitors risk 100% of the time on 100% of our traders. It's effectively like having a risk manager as you would a prop desk or a hedge fund, investment bank, any professional trading desk or arena that you're ever in, you will always have a risk manager. Now, that risk manager's job is not to generate a return for the fund or for the firm, but it's to manage all of the traders from an exposure perspective. Generally, the risk managers get to know the traders, they understand their strategy, they understand their styles, and they understand when the trader is kind of deviating from that style, from kind of like pattern-based behavior. For example, if I'm a scalper and I have a risk manager and then all of a sudden I'm holding a trade for 3 weeks, my risk manager is going to be looking at me and thinking, something's up here because Kieran's doing something completely out of the ordinary. That is the job for the risk manager, and of course to ensure that the trader isn't oversizing or over leveraging, and also undersizing and under leveraging themselves. Now, of course, when we built Darwinex, with the idea of being a global talent pool of traders from around the globe, we cannot implement a risk manager for every single trader, right? Because if you're like me, you're trading out of your bedroom or your own home, or you're trading from your phone, from work, whatever it may be. We can't just get a risk manager to come and tag along. It would just cost too much money, right? And there's not enough risk manager manpower out there to do that. Like I say, we have over 10,000 active strategies on the platform. We can't implement a risk manager for each strategy. So what we did was we tried to repackage that in the new digital age, especially in the digital age of finance. We built a piece of software that kind of replaces the need for a risk manager. We call it the risk engine. Now, what it does is it monitors your trading behavior. So it's looking for consistency over anything. It monitors your behavior over the past 45 days and 6 months for the biggest effect in terms of judging your exposure moving forward based on the patterns over the past 45 days and 6 months, making sure that you're not being over or under leveraged at any given time. It will adjust your trade size at Darwin level. So on your index, it will adjust your trade size to ensure we meet a certain value at risk level, which I'll get onto in a moment in the session. But it also will get involved in any trades that kind of go rogue. Now, what I mean by go rogue is you will have your average deleverage on your position. We do have some documentation if you want to understand a little bit more about deleverage, what it is, how it works, how we calculate it. I'd recommend reading through our K-base because I'm not going to go into it in this session. I don't know the maths behind it. I don't really care from a trader's perspective. I know it's there, and I know the risk engine does it all for me, so I'm not too bothered. But if you want to read up on it, just so that you're aware, I would check out the Darwinex K-base. All the information is on there. But the risk engine will monitor whilst you're in a position, your deleverage. If it exceeds the threshold of what is normal for your trading behavior over a certain period of time, it may intervene and start closing certain amounts of a position. Reason being is, again, like I said, if I'm a scalper and then all of a sudden I'm holding a trade for 3 weeks, clearly something's going to miss. I've either broken my rules, changed my strategy, doing something I shouldn't be doing, or simply I could be dead, right? As funny as it sounds to say that, you know, if you've got $10 million under management and, you know, the trader's not working from your firm or from your office and they die and they've got positions open, of course, we need to understand that. So the risk engine is there to protect you from all of these sorts of things. I mean, that is a very, very, very extreme example. And to my knowledge, it's never happened before. But the risk engine is there to cover things like that anyway. Okay. So now that we've got the understanding of actually what a Darwin is, what the risk engine is, we can kind of dive into how they work a little bit more. And I do think I'm going to overhaul all of these presentations anyway, especially if I go ahead with the Darwinex TV idea, because I'd like to integrate these presentations a little bit smoother, make them look a bit better, make them a little bit more informative, and get as much information in a digestible way as possible. So next point. In fact, before we carry on with this, there's a few questions. So let me take a look. PX Lou said, in terms of that, how do we define out of the ordinary in not so extreme term? Like would a risk difference of 1% and 1.5% be out of the ordinary? I'm presuming you mean from a risk engine perspective. As in you're asking what the risk engine would deem to be out of the ordinary, which again, it all comes down to your deleverage. So it accounts for the asset that you're trading, the clip size that you've put on, how long you're holding that trade for, and so many other factors. It's difficult for me to say that for every single trader, X percentage risk on a position means it's out of the ordinary. Okay, yeah, the risk engine. So it's kind of unique to you. So if you clip 0.1 lot on every trade, for example, and then you go ahead and clip a 1 lot trade, that would probably be out of the ordinary because it's 10x the risk or 10x the position size for that specific trade. But if I'm trading, you know, 0.9 lot and I go and clip a 1 lot, that's not going to be out of the ordinary. So it's kind of dependent on your style of trading, and so many different things that go into that calculation, which again, it's kind of towards the end of the presentation, but we do cover it in here. So I hope to answer some of your questions with that. 0.1 lot to 0.15, I wouldn't say so. With my XAQP portfolio, I'm clipping different sizes on pretty much every position. So for example, right now, if I drag it over so you can see, I'm in $3 yen shorts. 2 are 0.15, 1 is 0.41. But I have a steady, consistent VAR with that. So because I'm doing the same thing, even though the sizing may be different consistently over a long period of time, I'm doing the same thing. My behavior is the same. Okay. So I wouldn't be too concerned clipping an extra 0.5 lot, even if it's every once in a while. Like, I just won't be too concerned about that. Now, what is the point of having a Darwin? So first off, it's risk adjusted. Now, say what you want about being risk adjusted. You know, some people embrace it, which I think is fantastic. Some people don't like it because it kind of gives them a holistic view of their approach to the market, which sometimes traders aren't prepared for, right? Because it's a brutal look into how much exposure you take in the market. And some traders will argue, oh, well, I only risk 1% or 2% per position. It's what I've always been taught. I don't take much risk. But we don't classify your exposure based on the percentage risk or your max drawdown. It's how much exposure you're taking to generate your return. The best way we can find that is by looking at your value at risk, which we'll explore a little bit deeper in this session. Again, something we spoke about in yesterday's stream was Waka Waka, the EA. I mean, there's a few people in this session now. I'm pretty sure most people have heard about it. Again, the story was Waka Waka had a max drawdown of like 12% over a 5-year period. And then within a 2-week span or a 3-week span, it did minus 70%. So even though their max drawdown looked fairly okay, their position size looked okay, their value at risk was significantly higher than most trading strategies because it was martingale. Okay. So being able to understand your strategy at a deeper level, it kind of, like I say, gives you a holistic view into actually your approach and how you compare against benchmarks like the S&P 500, like property, like index funds, like other traders. And with us doing this, it puts everybody at Darwinex from a level playing field. Okay, so like I say, when you're trading against competition, which you're effectively doing at Darwinex, because Darwinia is a leaderboard and you're all fighting for investor capital, everybody is doing it with the same amount of risk. Again, we'll get into that in a moment. I'm kind of getting ahead of myself today. I'm just trying to flow. Number 2, you come under the Darwinex regulatory compliance. So as I mentioned, we have our own asset management license. We are regulated to do so. The Darwin is an index, which is an asset we are approved to allocate capital to and approved to hold capital for or hold investor capital for. You do not have to go out and become licensed, qualified, or regulated in your own right to manage that capital because it's held at Darwin level. Of course, that means that it's our name on the line, which of course means we implement the risk engine in the best way that we see fit. So I do get questions from traders quite frequently saying, you know, I have a track record. Can we adjust the value at risk because I don't want to be scaled down or I don't want to be scaled up? And I always say, listen, it's our asset management license that's on the line. It's us who's dealing with the regulators. It's us that is managing the risk for the investor, not you as the trader. Your job is to take the best trades that you possibly can. Our job is to minimize the exposure for the investor or to minimize things going wrong, let's say. Number 3, you get a proven track record. You get this twofold. You get your Darwin, which is a risk-adjusted track record. And you get your, of course, your broker statements like you would with any other broker. However, because Darwinex is a regulated broker, your broker statements are gonna hold up a lot better than, you know, if you're trading with a 1 out of 10 star broker who doesn't have any regulation or is regulated offshore in some bookie ass country. You know, if you walk into a hedge fund and you try and apply for a junior trader position and they ask for a record, you show them a Darwinex record. Even though through Zero the accounts are simulated, it's still run on live servers. It's still run with live conditions. So it's not a demo account, it's a simulated account, and there is a key difference there. PXLU, who would not want to get scaled up? Believe it or not, I've tested strategies in the past, and being scaled up really, really hurt. So I had one strategy before where I got scaled up 40x, believe it or not, and yeah, it really didn't work out well. The strategy was a piece of trash. You know, I was just testing some things, but there are some people who generally what I found, it's more the experienced guys who are happy with low returns, you know, in terms of they're doing 10% per year, but they've been doing that for the past 3-4 years and they're happy with that. Maybe they're a little bit older and they don't have the desire to take as much risk. They then trade with Darwinex and they see that their exposure is tuned up and they feel uncomfortable with that. But again, I always just say you need to detach yourself from your Darwin, because it's an index where you only have, 50% control. The risk engine has the other 50% control effectively. But yeah, it's a funny question, because again, on my XAQP, I'm scaled up 3.4x, right? So I think I was mentioning this yesterday actually as well, is I don't necessarily see the intraday volatility of my systems, because I'm trading it at such low risk. However, then when I load up my Darwin might be up 1 or 2% for the day, or down 1 or 2% for the day. Whereas on my master account, I might be down $100 or $200. So it can be a little bit unnerving when you're scaled up so much. But that's why I try and, especially if things are going bad, or I'm in a period of stagnation or drawdown, I try and not load up my Darwinex dashboard for a period of time. And I just try and focus on my balance and my volatility at master level. But that's just a psychological thing. Sometimes, I can't answer on behalf of other people. FX Physics, welcome, dude. It's great to have you back again. Hey, Kieran, do you know any case where trader transitions straight from zero to Darwinex Pro? No. So, okay, there's some. Firstly, there's some changes that are coming to Darwinex Pro. We haven't really had many traders over the years who've taken advantage of that. For what reason, I don't know. There's not too much difference between Classic and Pro, other than the fact you can go out and act more as kind of your own hedge fund and market it as such. From Darwinex Zero to Darwinex Pro, I would say the number is 0. Okay. Darwinex Zero has only been around 2.5 years, maybe slightly longer. So I wouldn't say it's beneficial for any traders at that point anyway to do so. But like I say, there are some changes coming to Darwinex Pro soon. And we have AMC certificates as well. So traders can do it in a slightly different way. But we haven't, or I'm not privy at least to the end outcome of that, how that's going to kind of be facilitated. So, but yeah, I would say the most natural progression anyway is 0 to Pro. I'm sorry, 0 to Classic, and then to Pro. The only caveat to that is sometimes, I mean, for example, my portfolio needs a certain amount of margin. So, if there's other traders out there like myself who has a portfolio which needs 50K margin or 100K margin in their account, you're not going to be able to open up, a 1K brokerage account or a 2K, maybe even not even a 10K broker account and trade it with the same system, because you might end up blowing the account. So I think there's a lot of traders who are in that boat who kind of sit on 0 because it's easier than depositing 20, 30, 50, 100 grand into a live broker account. But great question anyway. Rob Fern said, 40x, you mean the percentage amount? How that much mental? No, it was actually 40x. So I was trading really low size, really infrequently. I'm talking like 0.01, like the minimum contract size for tiny wins, tiny losses, and yeah, it scared me up just a huge amount. But yeah, it was mental. I closed that account anyway. Like I say, I was just testing different things out. I wasn't doing anything crazy. It wasn't like a strategy I had. So yeah, close that down anyway. Okay, So with all that in mind, your Darwin metrics are going to be different to the metrics you see on MetaTrader 4/5. They won't be too different, I would presume, for the majority of traders. However, if you do take a large amount of risk, then yes, you might be scaled back quite significantly. And if you trade like me with a really low size, again, you will see quite a significant difference. Again, my account is currently up 2.6K over the past 5 months. My Darwin is up like 15.5%. Okay, so that's 2.6% to 15%. It's a pretty big difference, but I trade with significantly lower risk. I hear risking too little can backfire. It can, if you're scaled up significantly and don't have an edge. Like if you're bleeding out, like if you're risking small, but you're still a losing trader, you're just going to bleed out slower, right? But your Darwin's going to bleed out slower at a higher or a faster pace because your exposure is going to be higher. Okay, so it will catch you out quicker if you are a losing trader, ironically enough. But there's no way it will backfire because it's a self-balancing mechanism between the VAR and the risk multiplier. So I don't really see too many scenarios where it backfires as such. So this is really key. Our risk engine, which I've been talking about since the beginning of this session, our risk engine adjusts every trader on our platform's trade sizes to maintain a value at risk, or what we know as VAR, of around 6.5% per month across the board. VAR estimates how much money you could lose on an investment over a specific period of time under normal market conditions with a certain level of confidence. Now, as I say every week, I appreciate that's a bit of a mouthful and a little bit confusing. So we break it down with an example here. If a trader has a VAR of $1,000 with a 95% confidence level over 1 month, it means that there's a 95% chance that the trader won't lose more than $1,000 in a single month. Bit of a poor example, I guess, because it should be 6.5%, not $1,000. But essentially what we're saying to an investor is the way that the risk engine is designed is that the maximum downside you should see in a given month or a 30-day period is 6.5%. Now, of course, we can only assure that up to a 95% confidence level. We are dealing with markets. We are dealing with uncertain outcomes on a daily basis. You know, black swan events can happen, bad things can happen, traders can keep continuously losing. And we're not saying or not guaranteeing that your losses won't exceed 6.5% in one given month. But the way it's designed with the VAR and the risk multiplier is that there is a low chance that that will happen. Okay. And just to say with that, there's nothing to say that a trader's not going to lose 6.5%. You know, a month, 10 months in a row, because if you're a losing trader, you're a losing trader. Okay. Doesn't matter how fast or slow you bleed out. If you don't have an edge, you don't have an edge. But I would presume if you don't have an edge, you're never going to get an investor anyway, because they will be looking at your performance and they're not going to invest into a trader who just keeps losing money month on month. So it shouldn't be an issue. Now, by us doing this, what it does is it creates a level playing field, ensuring that every trader is judged based on their skill and not just the amount of risk that they're willing to take, which is really, really important. Because if you have two traders who both trade the same strategy or the same system on the same asset, but trader A trades that strategy with a 1 lot and trader B trades that strategy with a 10 lot, they have the same target, the same stop, the same entry point. Is trader B better if he makes more money on that trade because he's 10x the size? Now, I guess there's an argument where you could say, well, he has more conviction, he's happier to take risk, but that's from a risk perspective. That's not from a strategy perspective or a skills perspective from the trader, because they both made the same trade. They both did the same thing. They might have different account balances, okay? So what we do is we level the risk between them. So trader A might get scaled up to a 5 lot. Trader B might get scaled down to a 5 lot. So they both take the same trade, but now their risk is standardized at 6.5% value at risk as well, which means that, you know, let the best trader win. Whichever trader takes the best trades moving forward generates the highest return with the same amount of market exposure. It's essentially like, I was going to use a weird analogy with like magic beans then, but as I went to say it, kind of didn't really make sense in my head. Nah, I don't think I'm going to be able to get that example to work. But it's essentially like everybody gets, okay, no, we'll do it. Everybody gets the same amount of magic beans, and it's whoever can grow the beanstalk as high as possible. There we go. That kind of makes sense. So, you know, the beanstalk is an endless machine of growth. Whoever can grow that higher with the same amount of magic beans is the better trader. Weird analogy, I know, but I thought I was too deep in that to kind of back out. Physics says, technically, say your Darwin is 3.4x, which mine is, rescaled upwards to meet the 6.5% VAR. How would investor positions be rescaled accordingly if max leverage is limited to 2, such as on equities, for example? The investor positions won't be rescaled from that at all, because they will be investing at the standard 6.5% level anyway. So it's only me that knows my strategy scaled by 3.4x, but the investor is putting their capital into the Darwin, which hasn't been, I mean, yes, it's been technically scaled from the master strategy, but that's at 1x leverage. Okay. The investor can go 1, 2, or 3x leverage on that specific Darwin, but they're already investing into the asset that is running at 6.5% bar, if that makes sense. Unless I've completely butchered what you're asking by that question. I don't think I am. Now, I feel like this is quite commonly known at Darwinex anyway, but you might be asking yourself at this point, why do we use 6.5% value at risk? And actually, historically, if you've been around the block with Darwinex for a long, long time, you will know that this 6.5% used to be much, much higher. Okay. And I'll tell you the story why it's now 6.5% and not a lot higher in a moment. So 6.5% value at risk is the S&P 500's risk level or level of volatility, which we know investors are familiar with and proven to tolerate over a large extended period of time. So essentially what we're doing is adjusting your strategy to a risk level that ensures it meets investors' expectations and risk tolerance. Now, I'll tell you the story because this will make a little bit more sense. When I do, we used to have the standard risk level significantly higher. Okay. I can't remember off the top of my head what it was, but somewhere between like 15 to 25% value at risk. I can't remember the exact figure. What we saw was a much larger investor churn, which is really bad, right? And the reason that was happening was investors were getting involved in Darwins. They were investing into Darwins at a much higher risk level than we operate at now. The Darwin would go through a drawdown. The investor would feel like they were overexposed or over leveraged. They would close their positions at a loss and they would walk away. It doesn't benefit the investor because they're taking a loss, and walking away. It doesn't benefit the trader because the AUM that they take in doesn't stick around long enough for them to generate performance fees. And it doesn't benefit us as a business because A, we need investors, B, we need traders, and we need that relationship to work because we take the fees, right? We take the management fee and we take a split of the performance fee. If there's no investor, there's no fees for us. So we have to find the level that satisfies the investor. Okay, which is the key difference here is we have to serve the investor because again, we're doing this from a regulated asset management perspective. Our protective responsibility sits at this point with the investor. Now, we do give the investors the opportunity to leverage up because we do understand that there's certain investors who have a much higher risk tolerance, meaning that 6.5% value at risk might be too low for them and they would like to have higher gains and they don't really care about the drawdown. However, as a standard, it's 6.5% because we know that investors are happy to park their capital in the S&P and sit on it for 10, 15, 20 years. And ideally, that's what we'd like investors to do with Darwin's. Park their capital, walk away, not worry about it. Not worry about the drawdowns, not worry about the returns until it's time to come in, and reap the benefits of their investment, essentially. Again, we do give investors the opportunity to scale up, but it's an option. It's not compulsory. Andy Bear said, hi, beginner's question here. If, let's say, I'm on a yearly plan and reset after a major drawdown, do I just pay the 38 euros restart fee and stay on my yearly plan without extra costs? Yes. So you can pay the restart fee. Your yearly plan won't restart. So let's say you've used 3 months of the yearly plan and then you restart. You will just, restart and still have the X amount of months, the 9 months left of that year. And the yearly plan should renew, whenever it's done. Physics said, thanks for your question, by the way, Andy. Physics said, okay, so Darwin's performance are normalized for risk to compare them on a playing field, exactly apples to apples. But investors trade nominal size and receive nominal performance, just making sure I understand. Yeah, but their nominal performance is based on the Darwin. So again, the Darwin is an index of the traders' trades and our risk management that builds the product, the index, which is your Darwin. That's what the investors buy and sell. Okay. So they're buying and selling the Darwin quote. They get exposure to the trades with our risk management. But so whatever level value at risk your signal account is, it kind of has no effect on the investor because they're investing into the thing that's already been risk adjusted to 6.5%, if that makes sense. No problem, Andy Bear. No problem. Skip that. It's pretty pointless slide. Every trader has this chart on in their account. So if you go into the strategy analysis tab on your Darwinex Zero dashboard and scroll down to the bottom, you'll find your value at risk chart. Now, this is a living and breathing chart or living and breathing document, however you want to call it. And the way that this works, again, as I mentioned earlier, is it measures your exposure and your behavior over the past 45 days, compares it to the past 6 months average, and ensures you're not being under or over leveraged by the risk engine at any given point. Now, you can see on this example, we've put a big white line where it says 6.5%. That isn't on your dashboard. You won't see that line, but we've put it here just so that you can understand what's happening when the trader's above it and what's happening when the trader's below it. So when the trader's above it, you can see their value at risk starts roughly at 13%, let's just say for argument's sake. Now, at that point, the trader's size at Darwin levels pretty much going to be cut in half. So we can say with confidence their risk multiplier is probably around 0.5x, which means if the trader's taking 10 lots on their MetaTrader, then their Darwin's going to be executing 5 lots. Exactly physics, exactly. That's the best way to think about it, yeah. Back to the chart. As I mentioned, it's an organic living and breathing chart. So as your behavior changes, if you start changing things with your strategy or your position sizing, let's say you want to bring your value at risk down and you start lowering your position sizing, which looks like this trader has done, their value at risk will begin to drop. Now, as I mentioned earlier, it's kind of a symbiotic relationship between your value at risk and your risk multiplier. They are inversely correlated. Pleasure, dude. Pleasure. As the value at risk increases, the risk multiplier will decrease. As the value at risk decreases, your risk multiplier will increase. Now, that brings kind of this full circle issue, which a lot of traders run into, where they want to normalize their risk multiplier at a 1x. Okay, so let's say a trader's at a 2x risk multiplier. A lot of traders, for some reason, want to get that 1x risk multiplier, meaning that their Darwin's trading pretty much the same size as their Signal account. But what they don't understand is that their Darwin is always going to come out the same result anyway. Because, like I said, it's a symbiotic, inversely correlated relationship that if you drop your value at risk, your risk multiplier increases. So, for example, if you're on 0.5x risk multiplier and you're trading a 10 lot and your Darwin's trading a 5 lot, if you start bringing your size down and making smaller return on your Signal account, your risk multiplier is going to increase, meaning that your Darwin will still come out the same result. Because if it's multiplying a smaller return by a bigger X percentage or by a bigger times amount, let's say, bigger multiplier is the word I was looking for, then your Darwin will come out the same result anyway. It is designed to be balanced at any given time. There's no real way to game the system, okay, because it will rebalance between the two metrics. As this trader hits 6.5%, their risk multiplier will roughly be 1-to-1, give or take, 0.1, 0.2. As they carry on going beneath 6.5%, their risk multiplier is going to get larger and larger and larger. Maybe it's 1.5, 2. As the trader hits 3.25% value at risk, roughly their risk multiplier is going to be 2x. Okay, so if I use the example of mine, because I've spoken about it quite a bit in this session, let's take a look. So can see, if we scroll down strategy analysis, we can see my value at risk is roughly 1.78 at the moment. Pretty consistent. It's slightly increased as I've added more strategies to the portfolio, but it's sat around 1.78%, which, is like 3 times less than the standard 6.5%, which means that the risk engine is looking at my strategy and going, this guy's trading with low size, so we need to scale him up. Okay, that's effectively what's being done here. Now, if we load up my live trades, you can see my current risk multiplier is 3.41x, meaning that any size that I take, as you can see here, I'm in 0.1 lots on EuroCAD, but my Darwin's in 0.34 lots. Perfect example because it's a round number, so you can see 341x, 0.34. Okay, so my Darwin is literally taking 3.41 times my risk on my Signal account or on my MetaTrader account. As this increases, my risk multiplier will decrease, and you can actually see that. So we know from the beginning, So even though it doesn't look like it's increased a lot, when my risk multiplier was, or sorry, when my value at risk at the beginning was like low 1%, or let's say it was 1% on the 14th of May, it's almost 2% now. Okay, so that's almost 100% increase. Even though we're still talking, tiny numbers, 1 to 2% is still 100% increase. And now that's why you can see on my risk multiplier, I started. Let's go all time. Yeah. So I started on 4.81x risk multiplier. So for every one lot I was taking or executing, the Darwin would be executing 4.81 all the way down to 3.41. Okay. So they're inversely correlated. As my value at risk has gone up, my risk multiplier has come down. Okay. So I hope that makes sense in terms of what I was explaining about this. And whichever side of the line you're on, you're going to be scaled up or scaled down. If you can keep your value at risk at 6.5% forever, I mean, fair play to you. I don't know how you would do that, but don't get caught chasing your tail trying to achieve a 1x risk multiplier, because you don't benefit from it as a trader. And it's just too much effort for, no reward, basically, because like I say, it's a self-balancing mechanism and the Darwin is designed to come out at the same end result anyway. So you don't really gain anything. Now, I've already just shown you this on my account, but essentially what we have here is it shows your risk multiplier. So exactly what we've been talking about, your current closure rate. So again, for the guys who've been in this session since the beginning, I was talking earlier about how the risk engine will intervene on trades that kind of go outside the norm from a deleverage perspective. So it will look at the time you're in the trade compared to norm, your deleverage compared to normal, and it will start clipping some of that trade off and scratching it. Potentially for a loss, potentially for a gain. It kind of has no preference. It will do it from a deleverage perspective. If it has closed some of your trade, this will, of course, not say 0%. Underneath, again, like I showed on mine, we have assets. So it'll show any trades that you're in. So Kiwi Yen, short 1.2 contracts on the master account, so the Signal account or the MetaTrader. And then the Darwin has executed 2.79 lots. Now, of course, with that, there is, obviously a balance multiplier too. So this is kind of theoretical, right? I guess to a degree, because if you're trading with $100,000 on your Signal account, but your Darwin only has 30K in investment, of course, it's not going to be clipping 2.79 lots, because that's based on 100K balance. Okay. So you'll have the risk multiplier as the first kind of multiplier for the position sizing, and then you'll have the balance multiplier. Now, if you're managing $100,000, which is exactly the same as your Signal account, the balance multiplier is 1 to 1. If you're trading 200K, it's going to be 2 to 1. So, of course, if you're in 1.2 contracts, your Darwin's going to be in double that, right? Yeah. I've already sort of explained this with Trader A and Trader B. The two traders both trading euro dollar with the same stop, target, and entry. Trader A trades with a 10 lot. Trader B trades with a 1 lot. The risk engine's going to look at those two traders, likely scale Trader A down, likely scale Trader B up until they meet in the middle at the standard risk level we use of 6.5% value at risk. I would love to know how many times I've said 6.5% value at risk in this session so far today. Maybe I'll get AI to run a transcript for me and see how many times I say that. Okay, on to some of the final points for the session. Your strategy's value at risk depends mainly on the following 4 factors. However, I separate these factors out into 2 different categories. So I have number 1, which is kind of strategy specific, and number 2, which is just position sizing specific. I'll answer your question in a moment, Jason, once I've broken this down. Now, the first 3 are all strategy specific metrics or measurements. Number 1 is asset volatility. So, of course, if you're trading euro dollar, it's highly likely that there's going to be less volatility than if you're trading Bitcoin, just by nature of the asset volatility. Number 2, how many trades you take. Number 3, how long you hold those trades for. Now, there's no good or bad when it comes to measuring these, but the more trades you take and the longer you hold trades for means that you have a higher inherent value at risk. The reason I categorize these as strategy specific is because you should never change your strategy to satisfy the risk engine. I don't want any of our traders to do that. You trade how you trade and you do the best as a trader, right? Don't change your strategy to satisfy your Darwin or the risk engine. Makes no sense. The one metric you can play around with, however, is number 4, which is your position sizing. If you did want to decrease your value at risk, slowly decrease your position sizing. If you wanted to increase your value at risk and decrease your risk multiplier, slowly increase your position sizing. Don't do it, catastrophically, where you go from trading a 1 lot to 100 lots straight away. Do it slowly, gradually implement that, because like I say, the risk engine looks back at your previous 45 days and 6 months worth of trading activity. So it's taking an average. Okay. So you can kind of build that average up over time or scale the average down over time. But what you don't want to do is go from 1 lot to 10 lots and have the average as 5, because it will start playing around with the expectancy short term of your strategy, because it will be struggling to figure out exactly the size it needs to trade. Okay. Whereas if you bring the average up or down slowly, it'll understand it a little bit easier. Now, I say generally, if you're going down from a 10 lot to a 1 lot, work it like 9.9, 9.8, like 9.7, and continuously bring it down, but slowly. And, spend a couple of months doing that. But again, don't get caught chasing your tail, trying to satisfy your own urge to get a specific value at risk percentage or a specific risk multiplier, because most times it doesn't really affect your Darwin. One thing I will say on that, though, before I move on, is what we've seen at Darwinex. Bearing in mind, Darwinex has been around now for 13 years. Okay. I'm talking about Darwinex, not Zero here. We've seen tens of thousands of trading strategies. In fact, tens of thousands, okay, of traders have come through, and we've assessed their strategies. What we can say categorically is that a trader with a 30% value at risk or higher has an exponentially higher risk of blowing their account. Not saying that it's guaranteed, not saying that 30% plus is a bad thing for every single trader, but if your value at risk is above 30%, you have an exponentially higher chance of blowing your account than somebody at 25, 20, 15. Okay. By nature of generally risking higher, it kind of makes sense, right? But the curve, it's like, if you've ever seen an exponential curve, you'll know that it's slowly and then all of a sudden kind of like peaks, right? And it's the same as you cross that 30% value at risk, the peak happens very, very, very quickly. So I usually tell people not to be worried about their value at risk unless it's above 30%. If it's above 30%, you have to be slightly concerned about the amount of risk that you're taking. Because again, what we've seen so many times over the years is that above 30, that trader eventually either blows up or goes through a really bad drawdown and ends up just walking away from the game because they can't handle the comeback. Because if let's say you lose 50%, and this is what a lot of people don't understand or don't think about, is if you lose 50% of your account, that's not, you don't have to make 50%, you have to make 100% to make that back, right? Like, let's say you go from 100K down to 50K. To get back to 100, you've got to double your money, which is 100% increase. So that climb is really, really difficult, especially when you're mentally beat down from, losing half of your account balance. Again, it's exponentially higher above 30. Yes, traders do it below 32, but the chance is so much lower. So I'm not even gonna bother with these frequently asked questions, because I don't think I pretty much cover everything in the session. This presentation needs a complete overhaul, which I promise you guys I am gonna do, because some of them, like I say, the FAQs is basic stuff like, should I stop trading? We all know you should never stop trading. Your age, you just need to keep trading constantly. The rewards will come. JC, not sure if you can answer this one. How does a risk engine scale, like scalings? So essentially highest expectancy setup versus highest expectancy setup plus a scaling, both at the same risk. It depends. So generally, if it's a scaling, you don't find an issue. If it's a scaling in drawdown and you start increasing size like a martingale, your deleverage explodes on that specific position, goes way above the mean, and the risk engine will be quicker to close some of the exposure. If you're in a trade, it's going well, and you're like, wow, this is a trade I need more size on. I'm going to clip it again. Basically what it does is it takes all of your trades In fact, I did a good video on this, a short form video, like 30 seconds. It takes all of your trades and creates a synthetic position. The position is where your deleverage is measured. Okay. So of course, every trade has its own factor of deleverage, but we're looking at your position as a whole. The scalings are in profit, not in loss for this example. Yeah. Whether the scalings are in profit or loss kind of is irrelevant in the question that you're asking, because it's less about, kind of the risk-free return of that second trade or what have you. It's more about the deleverage of the position as a whole. So if you're adding size, regardless of whether you're in a loss or profit, of course your deleverage is gonna get larger. Okay, which means the risk engine is gonna be more attuned to watching that exposure doesn't kind of creep out of the boundaries that it would like at that time. However, I have scaled in before. I know plenty of traders that do. If you're doing it consistently over a period of time, generally you won't have an issue. If you're scaling in by going, here's one lot, and then it starts moving for you and you go, oh, I'm going to clip a 10 lot because I really believe in this trade, the risk engine might be a bit like, holy smokes, like, whoa. But if you're going one lot, then another one lot, you shouldn't find an issue. What I noticed, and I'm not saying this is you, JC, by any means, but I always get the feeling that people are scared of the risk engine, like they're scared to do things. But don't ever be scared. Just trade, test things, try things out. Alternatively, get a second account. You don't have to do this because, of course, and I would never pressure anybody to do this. It means taking a second subscription. So if you can't afford a second subscription, of course, don't do it. But if you wanted to test things, I mean, I do it with BYXB. I have a second account. I test things on there. I kind of push it to its limits. I try different grid styles, martingales, breakout system. I just try everything to try and effectively break the Darwin. Okay. So don't be scared to do that. But like I say, people have this big fear. They feel like the risk engine's a big black cloud above them. But really, it's only going to get involved when your exposure exponentially gets bigger, right? When your deleverage swings our way out of control. And as a trader, if that's happening, right? If you're scaling into a good position, you're managing your risk well, you shouldn't really find an issue. Okay. But if you're going haywire and you usually clip a one lot and now you're clipping 100 lots because you're frustrated that your last trade lost, of course, deep down that the risk engine is probably not going to take a liking to that, as a risk manager wouldn't if you was working at a professional desk, right? You're not going to get away with clipping that size. Big pharma versus big risk engine. I wonder which one's the biggest evil. But yeah, like the way I always think about it is, with the risk engine, again, we designed it to replace the need for a singular risk manager. If you're placing a trade, imagine you have a risk manager sat next to you watching you clip that trade. Are they going to be happy, or are they going to be a little bit concerned about what you're doing? If the answer is concerned, then the risk engine is likely going to be concerned. If the answer is the risk manager is probably going to see the vision, they're going to understand that they know that this is a high probability setup, so they'll be comfortable with me adding another lot here or another lot there, then generally you can take that same notion across to the risk engine. Okay, the risk engine will be relatively unbothered by this as well. That's the best way to think about it. Don't think about it as being this big scary thing that I don't know what it's going to do, whether it's going to like this or dislike that. Just try it out. Try it out. You'll get instantaneous feedback. You'll know. Like I say, I run grid positions on BYXB. It's very, very rare that the risk engine ever closes exposure. I think it's done it once or twice. But again, I do game the system a little bit in terms of I run the grid really low risk and I hedge it with some breakout strategies and some mean reversion strategies running at higher risk, so that we kind of take the baseline of my value at risk from those higher risk strategies, allowing the grid a bit more room to breathe. But yeah, don't be too concerned, dude. Don't be too concerned. SD said, I passed the calibration. My rating is 82. Fantastic. Well done. When will I be eligible to get allocation and payout? My Darwin is ZLEO. Well, let's bring it up because that is a fantastic rating, especially on your first month. Answer to your question is that you will get an allocation at the end of this month. So in a couple of days, you will receive your first Darwinia Silver allocation, likely on Monday. Sorry. Here we go. you will receive, yeah, so you have to have a rating above 75 to receive an allocation in any given month of Darwinia, or at least in Darwinia Silver. Obviously, you're above that, you will likely get 40,000 euro, maybe, I think, at that point, with a rating of 82. In fact, I might be able to figure out exactly how much it is. Let me take a look. Yeah, so you'll get that. You'll get that in a few days, and then the payout is quarterly. So that will start on the date that you get the allocation, unless you've upgraded to monthly performance fees. Then you'll get it every month. Where am I going? Rating calculator. So my rating's at 91 at the moment. Let's try and get that down to, what's yours? 82.2. Okay, so looks like you'll get 30k. Okay, so even with an 83 rating, it'll be 30k euros. So you get your first 30k allocation in a couple of days, and like I say, that starts your high watermark ticker timer, whatever you want to call it, which will either be a month or quarterly, depending on your choice of payout schedule. But this looks great. I mean, it's a little bit too early to say anything about the strategy, really. I mean, it's got the devil number, so that's always a bad sign. Your current position is the devil, and also your avatar looks a little bit like the devil. So maybe this is quite telling. But yeah, great return anyway. I mean, looks super good. I'm gonna keep an eye on this for sure. And yeah, welcome to Darwinex Zero. Oh my god, can you hear the storm? Can anybody hear that? It's like I got my window open. Maybe I should probably close that. Or at least close it to a little bit. It's come out of nowhere like 3 times today. Just absolutely blasted down. Once when I was walking my dog as well, so I got absolutely soaked. JC said, makes sense. Thanks for the explanation. Also, whilst on the topic, how often does it recalibrate the Darwin risk multiplier? Every day, every minute, every second. Is it that 45 days that you mentioned? Not scared, just curious. No, it's like I said, it's a living, breathing thing. It will update, every second based on what you're doing as a trader. Okay, so every decision that you make has a direct impact on your value at risk. Therefore, your risk multiplier. Therefore, your Darwin. But yeah, of course, it's like tomorrow, the initial first day of that 45-day period will drop off. So it's kind of like your average changes every 45 days, but every decision that you make will update it in real time, if that makes sense to a degree. I don't know. It's been an hour of me chatting here. I'm probably just rambling at this point. Interestingly, I've noticed these streams are getting a lot longer recently. I think these streams used to be like 20 minutes, as in I used to sit on and do this presentation for 20 minutes. But as I've been talking about the past week, a lot more people are coming in and asking questions and getting, a little bit more involved, which I absolutely love because it gives me a purpose instead of just sitting here reading a presentation. But this hour's just flown by. So I appreciate every single one of you for jumping on, asking questions, and kind of getting involved. And I'll give everybody. We'll wrap it up in a moment. I'll give everybody kind of another minute or so. If you do have any more questions based on anything that we've gone over today, just ping it in the chat, whether you're on X or YouTube. Maybe you'll look at the marketing budget. What? Because I get more time on here. I am marketing. Jay said you can rely on a few spam questions stream from me. So yeah, I mean, it's always a pleasure to have what we find, especially with Darwinex, is we get guys in the community who embrace us, who we are as a company, and what we can do for you as a trader. And they generally become really active. And we were trying to think of a name for them at one point. We have people like Typhoon, Maestro, Diana. There's a lot of people, even yourself now, JC, who turn up to these sessions, who talk in the community and just understand who we are and what we do, and kind of have that same vision in mind. So it's always great to have people like yourselves come and just, even if it's just to come and chat rubbish and nonsense for an hour, it's great. That's why I want to do Darwinex TV, right? Where we just get random people on from the community, chat about trading, chat about Darwinex, look at some markets, watch NFP live, for example, and all that good stuff. I ask the most basic questions as well, Jason. I mean, sometimes the basic questions are the ones you need answering, right? Especially when something's so complex. Like Darwinex is easy for me to understand because I've been here for 2.5 years, right? Well, just under 2 years, but I was working with Darwinex beforehand from like a partner perspective. So I've been around the block with Darwinex. I understand the business inside and out. I see the back end, I see the front end. It's easy for me, right? I think a lot of what we have gets lost in translation. For example, and this is something that is on us as a business, like we need to improve this. But it's like a Darwin is an index, okay? But we've created a new term for it. So, like for us, it makes sense. We go, oh, your Darwin is just an index of your trades plus the risk management. But for a new trader, especially somebody who's not too literate in markets and in this environment, we're putting a blocker in the way by saying, oh yeah, it's an index, but now there's a new term for it as well that you've got to learn. So it's quite a difficult concept to understand, but I feel like when you embrace the concept and the idea and Darwinex in general, you really realize that there's so much value in this, even down to like the strategy analysis stuff. There's so much value in having an account and just trading it and learning about your strategy. No risk to your own capital, no risk to having to go out and network with investors because you've got the marketplace. Like, just embrace it for what it is. But I'm rambling at this point, so I'm gonna stop. Do you have any staff benefits, Kieran? Like no monthly sub? Yeah, of course. I mean, of course, I get paid, a good salary. I love working with Darwinex. I have a great life. Like, I was, put it this way, I was unemployed for 2.5, or I shouldn't say unemployed. I was self-employed for like 2.5, 3 years, where I just traded. I just traded and played around with crypto for a long period of time. Kids paid in Richard Millers. I wish, mate. And I come back to employment for Darwinex because I stood with a vision. And if there's one thing I can say about Darwinex is the guys that are at the top, the founders, the owners. I mean, these guys I speak to on a daily basis. I have a really good relationship with them all. They are some of the nicest people you will ever meet. Their heart is in the right place. Like, the business vision is the same as their personal vision. Like, they're just fantastic people, and it's difficult to not want to be a part of that, right? Like, I am one of only a few members of staff in the UK. If I ever want to go to Madrid, they'll fly me out. I can go out, spend time with the team, which is always great because Madrid is a stunning city. But I get the freedom and the flexibility to do what I do what I love. Like, it's just a great place to be. But yeah, I do get staff benefits. Like XAQP for me is, I don't pay a monthly subscription for it because it's the business that I'm trying to build and grow, right? However, I did say to them before, I said, I have no issue paying the monthly subscription because essentially, like, I'm getting a payout next week, so it's like I don't mind paying it. The founders seem like top guys, to be honest. Yeah, they are. All of them are fantastic. They are just, even if they're like a different kind of people to what you're used to, or you're like, that guy wouldn't be my friend. There's one thing that you can't argue, and that is that their value is in the right place. Whether you like it or not from a business perspective, there's things such as, like, we don't B-book traders or internalize them. So we don't bet against our traders at all. Okay. We might internalize them, but we don't bet against them. So we don't have that B book functionality. We have the A book because the traders go to market, simple as. But we don't bet on traders' failure as a business model, right? And that comes directly from the founders. Javi himself, the genius behind Darwinex, is and was a trader. And it's kind of bet against me, free money. Yeah, I mean, we can all make rubbish trading systems and just fade them, right? But yeah, just fantastic guys. Physics said, when applying for pro, would we have to fly to Madrid or London to meet with staff? I don't think that's mandatory. Like, I don't think you would have to do that, but for sure, like, you could do that. Like, if you're ever in, I would say Madrid. Madrid is like the head office. London, we have it because we need it for regulatory purposes. So our London office is in this building. It's absolutely fantastic. I love going down there. It's in The second biggest building in London behind the Shard, which is 1 Canada Square. So the top of this is a hotel or a university or something like that. And then we're on level 39, which is one of the, I think it's the top floor of the office buildings. And it's fantastic. It's rare that I go down there, but when I do, every day, right, they come out with a tray at like sometime in the afternoon. They come out with a tray with freshly baked cookies, put them on the side. It's just phenomenal. They come out with pizzas. There's cans of Coke, Diet Coke, water, coffee, all included. Like, it's just a fantastic place to be. However, in Madrid, which is just a stunning city, if you've never been to Madrid before, go to Madrid. It's one of my favorite places I've ever been. It's just an absolute fantastic place. This is called Gran Via, which is one of the biggest strips in Madrid of like shops and like restaurants and stuff. Just a great place. But that's where the majority of staff are. They're all in Madrid. Okay, there's only like I say, I think there might only be 2 of us now in the UK, maybe 3. But obviously I'm not in London, so I'm never in that office. I do have access to it though. So if anybody's ever in London, like, let me know and I can always make the trip down. I'm a couple of hours away, but always happy to make that trip. But to go back to your question, Physics, it's not mandatory, but there will never be. Yes, Canary Wharf, 1 Canada Square. It's in Canary Wharf. It's not mandatory, I don't believe, but it's always like optional. Like if you're in Madrid, of course, come in and spend the day with the team, sort of thing. Risk 1% said, I want to change to monthly payout, but only when got millions under allocation. If I don't purchase a monthly option now, will I get another chance in the future? I don't believe so, dude. I would double check for you, but I think you have a specific period of time, either when you start your account or if you had an old account, to make that switch. If you don't make that switch, I believe there's no Uno Reverso card. So I would potentially make that decision. What's important to remember though at that point, if you've got millions under allocation from real investors, right, is that your high watermark isn't every 3 months. It's every 3 months at that point. Like if you're on a quarterly high watermark, it's from the date that the investor signs up. So I mean, we're looking more at Darwinex Classic guys here, the guys who are, in the multiple millions, unless you're looking at traders like Wissy, who is over $1 million in investor capital. They might have 100 investors, 200 investors. I think Atu used to have like 1,000 investors. Okay, so he was probably getting a payout every single day because it's all dependent on when the investor invested. So let's say you got 365 investors. Essentially, you've got a payout per day on average, right? Because you've got 365 investors. That means 365 days that somebody started. So every 3 months from the day they start is when you're getting paid. Of course, it's not going to work out like that, but I'm just saying on average to keep it simple. So even though you'll be on a quarterly cycle, if you're trading with investor capital, it might not have to be every 3 months that you get a performance fee. I think I butchered that with just too many words, but let me know. No, we have 2 offices down in London, Gabs. We have our actual office, which is the office for staff and for regulation purposes. And we also have a secondary office, which is like a mail-in office or mail-in address. I mean, Jason, I'm going to have to find out the time of day they bring out these cookies because they are unbelievable. And they're literally like this big, right? But you have to go quick because everybody runs out and grabs them all. But like I say, if anybody's ever in London and they want to come and say hi, like I'm always happy to make the trip down. I'm only usually there once a month or once every couple of months. But I never say no to a trip down to London. Anyway, guys, looks like we've gone through all of the questions. I've been on for an hour and 10 minutes on a session that usually takes me 20. So it's been fun. It's been great to just sit and chat. That's the thing that I enjoy most about these sessions, just chatting with you guys, having a good laugh and going over some important stuff. We will be back on Monday, I believe. I need to check with Sanj. He's had some time off. I think he's been traveling. So I'll check whether we're doing a performance session on Monday. If not, we'll be back on Tuesday for a welcome session. But from next week, I might try the Darwinex TV idea. So yeah, I got some planning to do. But anyway, guys, I hope you have a fantastic rest of your day. Wherever you are in the world, have a great morning, evening, or afternoon. JCid, go get some sleep, dude. You'll be up soon to trade London Open. And yeah, have a fantastic rest of your day, guys. I'll catch you all later. Peace out. I went Australian then for some reason. Don't know why.